Hi, this is Chris Grenier. I'm here with Matt Bell and Bell and Van Grandel CPA firm, and he's here to talk about some of the tax implications that you're dealing with your property in America. And he's obviously the expert. He's a certified accountant here in Florida, so I'm going to let him do some explaining, and I'm going to let Matt take it over.
All right, sounds good. Thank you. Well, as Chris mentioned, we're going to go over some of the issues with individual property ownership for foreign real estate investors. And as he mentioned, I'm a certified public accountant here in Florida. We deal primarily with foreign investors in U.S. real estate. That's kind of our niche here in Central Florida. So I want to go through a few points that might help you in your decision-making process on the purchase of a property here. And actually, for individual investors, especially, I know a lot of you all are from the United Kingdom, the tax treaty between the U.S. and the U.K. really provides some great benefits for property ownership here. So let's go down a couple of these points. The first question you probably want to ask yourself when you're looking at a property is, who will the owners of that property be? And we have a couple options. If you have a husband and wife, or maybe a son and a father that are looking to purchase properties, you can either have one of them purchase it, or you could actually have a husband and wife jointly sign, or possibly a father and his sons, or a mother and their sons or daughters sign on of the deed. But one of the advantages to having multiple owners is that each, and hopefully you can read some of this, each of the owners gets a $3,800 exemption each year against their net income before they pay any tax in the U.S. So, if you have one owner of a property, that means once you take your rental income and subtract off all your expenses, you have another $3,800 before you have to pay a dime of U.S. income tax. Each owner that you add on, you multiply that $3,800 by each owner. So if you had 4 owners, you got 4 times $3,800 per year before you have to pay any income tax in the U.S. One other thing I want to mention is I-10 numbers. Once you purchase a property here in the U.S., annually you'll need to file some income tax returns, and you're going to need to apply to get an I-10 number. Each owner of the property will need to get an I-10 number, and that's something that our firm can assist you with. It's a pretty easy process. We get a notarized copy of your passport, and we send it in with some documentation, and then that I-10 number identifies you with the U.S. taxing authorities and tells them this is you when you're filing that income tax return. One thing I want to mention about applying for these I-10 numbers, it doesn't allow you to work in the U.S. and it also doesn't draw any of your foreign income into taxation in the United States. If you live overseas, the only thing that's ever taxed or reported in the United States are the properties that are physically located here. Now we're going to talk about some of the tax filings that you're going to be required to take care of once you own your property in the United States. And I have a few of these listed here. The first thing I want to mention, and I've kind of given you the form number on this board, is a Form 1040-NR. That is a U.S. non-resident alien income tax return, and you're going to need to report your rental income and your expenses on your properties on that form every single year. A couple things I want to mention with this. We handle about 300 individual non-resident investors, and I think last year we didn't have one of them that owed income tax. And the reason for that is a couple things. Number one, as I mentioned before in the previous point, there's the $3,800 exemption per owner that allows you to take that off of the income before you have to pay any tax. And also there are a couple other really good expenses besides all the normal things you would think you could deduct, such as your property management fees and your property taxes and maybe your utilities and things like that. I have a couple other items listed. One of them is travel. If you decide to come over to the U.S. to take a look at the property you're going to purchase, that travel cost is deductible on your income tax return. And also, if you decide to take trips over to the U.S. to do an annual inspection, or maybe even twice a year to inspect your properties, those travel costs are deductible as well, and that would include your flights, your car hire, any hotels that you need to stay in. And then one other thing I wanted to mention is something called depreciation. And what that is, the U.S. taxing authorities, even though your property may be increasing in value, they allow you to take a deduction for the wasting away of the property. So even though your property may be cash flowing and you're getting money out of it, there's a deduction we can take, which is roughly about 1/27th of the value of the property every year, what you purchase it for, we can take as an additional deduction against income. So that's a great benefit for foreign investors. And once you add up all of these things with the exemption and the depreciation, the travel deductions, it's very, very unlikely that you're going to have to pay any income tax in the U.S. annually. And if you do, it's normally a very small amount. The second thing that I wanted to mention, as far as a tax return to file, is what's called a tangible personal property tax return. If your property that you're purchasing has furniture inside of it, appliances, things like that, many of your properties may not if they're long-term rentals, but if they do, there's a tangible personal property tax return that has to be filed every year. The good thing about that is, unless you have more than $25,000 worth of furniture in your property, there's no tax on that. Has to be filed to get the exemption, but there's normally no tax to pay because of that $25,000 exemption. The third thing I wanted to mention was state income tax. Depending on which state you're investing in, you may have to file a state income tax return. Here in the United States, we have 50 states, and each state has different tax laws on which ones have to file state income tax returns and which don't. The state of Florida, which is where we're located, actually does not have any state individual income tax, so there's no tax return filing there. Some states such as Michigan, New York, New Jersey do have individual income taxes, and a state income tax return would need to be filed. Same type of things are reported, the income and expenses on the rentals, same type of deductions, travel, depreciation, so when it's all said and done, 99.9% of the time you will not owe any state income tax on those properties. All right, let's talk about capital gains a little bit in the United States. Because you're purchasing a property here, obviously one of your primary objectives is to have some capital gains when you go to sell the property. One of the good things about investing in the United States right now is that our capital gains are actually relatively low on the taxation side of things. And I mentioned here 5/15%. When you sell a property that you've owned for at least a year, the maximum capital gains rate is 15%. And that is on the appreciation. It's not the total sales price, it's just what you've actually made the capital gain on the property. The really neat thing is that the first $30,000 of capital gains per year is only taxed at 5%. So let's say we had maybe a little bit of income in the year of sale, and we mentioned before about this $3,800 exemption. The first $3,800 is tax-free. Up to about $30,000 after that roughly is at 5%, and then anything above that is a maximum of 15% on capital gains. Just to throw this in here real quick, in the United States also we have something called a Section 1031 exchange. I don't really have that listed here, but you do have the opportunity if you're deciding to hold on to a portfolio in the United States and continue to build it up. When you sell a property and you have appreciation, and you decide to buy something of equal or greater value, the neat thing is you can actually roll that gain over and not have to pay any income tax currently. It's a deferred gain on the sale. So that's one of the other great advantages to investing in the United States. All right, now we're going to talk about something here that is a very strange word, and I've written it on here. It's actually an acronym, and I pronounce it FIRPTA. And actually this stands for all of you tax fans out there, it's Foreign Investment in Real Property Tax Act. And basically what that means is that when a non-U.S. person, a foreign investor, sells a piece of real estate in the United States, there's a withholding on the sale. And I didn't write it on here, but it's equal to 10% of the sales price. So let's say you purchase a property, an investment property here, and 3 or 4 years down the road you decide to sell it. When you go to sell it, there's going to be 10% of the sales price withheld as a holdback against tax. Now, that is not a tax per se, but it's more of a deposit just to make sure that you pay any capital gains tax that we mentioned up here in the 5 and 15% range on the gain. So normally what we do for clients is that if there's a 10% withholding, if they let us know far enough in advance that they're wanting to sell, many times we can get that 10% removed before the sale even takes place. If it's a quick sale, we haven't had a lot of time to get the tax forms filed, then what happens is we file some forms with the Internal Revenue Service. The title company or the closing agent actually holds on to that 10%, And then once they get the approval back from the Internal Revenue Service, our taxing authorities, they release that 10% back to you minus any capital gains tax that would be owed. All right, next point, tax treaties. There is a tax treaty between the United States and the United Kingdom, and it is a double taxation treaty. And what that means is that if you do happen to owe any income taxes here in the United States, or you have any capital gains taxes on the sale of your property, great thing is that the United Kingdom Inland Revenue actually will take and give you a income tax credit for any tax you pay in the United States. So if you're reporting the income and capital gains in your home country, that's one great advantage of that tax treaty, is that you can take advantage of that foreign tax credit. So no double taxation, you're only paying it one place. Last couple of points I want to mention, and probably many of you are curious about, are what are the costs of accounting with dealing with these things. Well, when you deal with our firm, couple of things we'll do is get your ITIN numbers for you. We'll deal with the 1040 NR and the tangible and state income tax returns. The costs to handle these three items right here are $440 per year for one property. Once you start adding on each additional property, it's $150 per additional property. So to give you an idea for budgeting, I wanted to mention this also down here at the bottom, other ownership forms. A lot of folks that we have call us ask questions about, well, I heard from my friend, or I saw on a website that maybe I ought to purchase through an LLC or an LLP or a corporation or a trust. Those are all options for you. One thing I want to mention is that when you start getting into these type of entities, they're more for a sophisticated investor that may be purchasing 5, 10 properties. 1 or 2 properties, individual ownership is probably going to be perfect. When you start getting into these type of structures, you're looking at probably $1,500 to $2,000 a year upwards in accounting fees and also in legal fees. So the great thing about individual ownership, very cost effective, provides a great income tax rate, actually the lowest of any of these other structures for you in the United States, and it's very simple to understand. So if you have any questions on these items, I'd be happy to have you visit our website. It's www.bellvancpa.com. It's BELLVANCPA.com. We'd be happy to talk with you.